Welcome back to Alpha Recap. We've got a packed wrap of the day. Markets closed with a clear split between winners and laggards, and we're here to walk through the takeaways. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be back. Lots to cover. Tech and crypto led the charge, while banks and parts of real estate felt the heat. So, what really stands out here is how concentrated the upside was.
Yeah, exactly. Quick preview. Bitcoin ran, oil popped over $100 a barrel, the Department of Energy put out a 5-gigawatt nuclear push, and banks were under pressure because of a bond market sell-off.
Right, and those are not isolated headlines. They connect to sector rotation, capital flows, and policy risk. But let's unpack it piece by piece.
Starting with the winners, technology again had a strong day on AI pricing moves and product news. Big names and conferences kept investor focus on monetization.
There was a lot of chatter about long context pricing from Anthropic, Netflix committing up to about $600 million to AI initiatives, and NVIDIA GTC tailwinds continuing to matter for cloud and chip demand.
And that monetization angle matters a lot. It's not just growth for growth's sake. The market rewarded companies that are starting to turn AI usage into revenue.
Exactly. Software and cloud names that can charge for differentiated AI capabilities are being treated differently than pure-play growth names.
Now, crypto. We saw a meaningful move there.
Bitcoin pushed above $71,000 today, and tokenized treasury flows and stablecoin growth were front and center.
Circle's tokenized yield stablecoin, USYC, reached about $2.2 billion in circulation, which matters because it smooths institutional on-ramps into crypto.
Yeah. Big stablecoin pools and tokenized treasuries reduce frictions for institutions. More liquidity equals more flows into crypto-related equities and ETFs.
Short reaction.
Big move.
Materials and mining also had constructive action. Project milestones, financings, and a real appetite for critical minerals.
We saw financing headlines like about $42 million in a fintech round tied to the space, and an oversubscribed $35 million raise for a developer. Those raises signal real investor appetite for upstream exposure.
Right. And the focus remains on companies with funded final investment decisions and offtake agreements. Execution matters more than story at this stage.
Utilities had pockets of outperformance too. There was 39 gigawatts of interconnection demand called out, plus storage pilots and other clean energy financing that lifted select regulated names.
And then you've got the DOE stepping in with that 5-gigawatt nuclear uptick initiative, which was another support pillar for cleaner baseload options.
Which is interesting because it shows policy can cut both ways. Tighter bank rules on one side, DOE support on another. Regulators are shaping winners and losers at the sector level.
Let's pivot to the laggards. Finance and banking were a clear underperformer today.
The bond market sell-off and talk of tougher bank rules pressured regional banks, mortgage lenders, and credit-exposed groups.
Rising yields are a two-edged sword. Higher yields can help net interest margins, eventually, but the immediate impact is mark-to-market hits on bond portfolios and tighter credit conditions.
Right. And regulatory tightening can reduce return on equity and slow M&A appetite among smaller banks. So investors were de-risking duration exposure and watching loan book concentrations closely.
Short reaction.
Not what anyone expected.
Real estate had mixed headlines. A big take private and a large industrial lease. But underneath, there's still bifurcation.
Yep. There was an about $2.3 billion take private and a 1 million square foot industrial lease, which shows private capital still finds value. But senior housing supply problems and geopolitical CRE concerns are keeping other parts of the sector on edge.
Healthcare was mixed too. Biotech approvals helped some names, but payers and providers are under policy pressure ahead of Medicare decisions.
Policy uncertainty around reimbursement and prior authorization reforms is compressing the group. Until we get clarity, investors are asking for higher risk premia.
Okay, major moves explained. Let's walk through the top stories one by one and why they mattered for investors.
Good plan. Starting with crypto. BTC above $71,000 and big stablecoin flows.
What happened? Bitcoin pushed to monthly highs and tokenized treasury products alongside large stablecoin pools made headlines. Why it mattered. Easier institutional on-ramps increase flow potential into crypto ETFs and related equities.
Investor angle. If you have crypto exposure, size positions, and prefer regulated vehicles like custody solutions or spot ETFs. Watch tokenized treasury flows as a liquidity proxy.
Next, energy. Brent topping $100 a barrel, though there was a surprise inventory build from the Energy Information Administration that tempered the move.
Right. The International Energy Agency intervention headlines helped push Brent above $100. But the EIA inventory surprise created intraday whipsaw. Why it mattered. Stronger oil lifted inflation expectations and pushed yields higher, a macro risk for rate-sensitive sectors.
Investor angle. Favor integrated producers and midstream names that benefit from price strength, but hedge for policy or supply shocks that could reverse gains quickly.
Back to finance. The bond sell-off and tougher bank rules dominated. Rising yields hit bank bond portfolios and raised funding costs.
Investor angle. De-risk duration. Scrutinize banks' hedging of rate risk and favor banks with diversified non-interest income and lower CRE exposure.
Utilities and the energy transition. That 39 gigawatt interconnection demand and the DOE 5 gigawatt initiative are big for grid investment expectations.
Why it mattered. Elevated interconnection demand signals faster renewable buildouts and more transmission capex. That supports regulated utilities and asset-light renewables plays.
Materials and mining. Developers advanced copper, gold, and critical minerals projects and raised capital, including that oversubscribed $35 million raise, showing investor appetite for upstream exposure.
Investor angle. Tilt to companies with funded FIDs, permits, and offtake agreements. Avoid early-stage projects with heavy permitting risk unless the valuation is compelling.
Technology and media. Anthropic's pricing, new product launches like Atoms from veteran founders, and content plus AI deals from streaming firms kept monetization conversations alive.
Yeah, Travis Kalanick launching something new. Surprise. But the bigger point is that hardware and cloud demand from AI cascades into chips, data centers, and materials.
Investor angle. Prioritize software and cloud names that can actually monetize AI usage and media firms with strong content pipelines and distribution economics.
Quick check-in. Reactions only.
Yeah, that tracks.
Okay, let's move to actionable insights. First, position for bifurcation, not a single market direction.
Tilt towards secular winners, AI infrastructure, selected renewables, critical minerals, and reduce exposure to rate-sensitive and policy-exposed sectors like CRE-heavy regional banks and senior housing operators.
Second, monitor rates and the yield curve closely. The bond sell-off is the proximate driver for banking and real estate pain.
Even modest further rises in short-term and long-term yields will pressure leveraged sectors. Use stop losses. Consider hedging duration with T-bond futures or short-duration bond ETFs.
Third, be selective in energy. Prefer integrated cash flow names and renewables with contracted revenue.
Oil moves open opportunities but raise costs for others. Favor integrated E&P and midstream, plus regulated renewables and utilities with contracted offtake.
Fourth, size crypto exposure and use regulated vehicles. Again, tokenized treasuries and big stablecoin pools are smoothing flows but add liquidity-driven volatility.
Fifth, target materials with execution-ready projects. Those oversubscribed raises mean winners exist, but prefer near-term production and binding offtake.
Sixth, in tech and media, prioritize monetization and margin expansion over pure growth. AI excitement is real, but execution matters.
And seventh, in real estate, favor industrial and logistics and essential services. Big institutional take-privates show value pockets, but overall, CRE faces cross-currents.
Short reaction.
Yeah, absolutely.
Let's call out the near-term watch list for the coming week. Fed commentary and data. Weekly EIA inventories. Bitcoin and stablecoin flows. AI conference updates and state and federal policy moves like cannabis referendums or Medicare decisions.
Those headlines will drive volatility. If yields stay elevated and oil stays above $100 a barrel, expect continued rotation away from rate-sensitive sectors. If oil cools and yields fall, we could see beaten down cyclicals bounce back.
Final takeaways. Be selective and size positions. The market in 2026 is concentrated. AI, energy transition, and crypto institutionalization are powering pockets of upside, while macro and policy risks are pressuring others.
Right. Discipline on position sizing, liquidity, and hedging will be the difference between capturing upside and getting run over in volatile tape. Own balance sheet strength and direct exposure to secular tailwinds.
All right, if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be watching those Fed comments and EIA prints closely. Tune in for the next recap, and don't forget to send in your questions at stockalpha.ai.